In January 2024, 11 of the largest financial YouTube channels all made the same prediction. They told their combined audience of over 100,000 subscribers that silver would hit $100 per ounce before the year ended. Some went further, claiming the COMEX would collapse, that banks were panicking, that physical silver had completely disappeared from the market. Fast forward to today, and silver is trading at $74. Now, before you click away thinking this is just another hit piece, let me be clear about something. I own silver. I've been accumulating it for 3 years. I believe in the fundamental case for precious metals. But what I witnessed over the past 12 months wasn't analysis. It wasn't even optimistic forecasting. It was something far more dangerous, and understanding why these predictions failed will tell you more about how to actually make money in this market than any $100 price target ever could. Let me show you exactly what happened. A channel called Financial Revelations posted a video titled Silver Hits 100 Before March. The COMEX liquidation begins. The thumbnail showed silver bars with flames behind them and the words, "It's happening," in red text. That video got 47,000 views. 2 days later, Finance Meet History published China just triggered the biggest liquidity crisis in U.S. history, claiming that Chinese silver demand would drain COMEX vaults by February. 68,000 views. The Exposure Index, a channel based in Brazil, went even further with the $91 silver shock Shanghai Prince reality. COMEX is in trouble Monday. These weren't fringe channels. These were operations with professional production, regular upload schedules, and audiences that trusted them. So what actually happened? Let's look at the data, not the speculation, but the actual numbers. Silver started 2024 at $24 per ounce. By March, when Financial Revelations predicted the COMEX liquidation, silver had climbed to $26.50, hardly a collapse. The COMEX, far from liquidating, processed over 200 million ounces in delivery that quarter, which is actually slightly below the 5-year average. There was no crisis. In April, silver did spike dramatically. And what happened? Happening. But their predictions weren't for $32, they were for 100. And they weren't predicting a temporary spike. This is the first mistake these channels made, and it's crucial to understand because it affects how you should process all financial information on YouTube. They confused volatility with validation. Asset. It always has been. In the past decade, we've seen multiple 20 to 30% moves in both directions within months. A spike to $32 from $24 is a 33% move. That sounds dramatic, but it's actually not unusual for silver. In 2020, silver went from $14 to nearly $29 in 5 months. In 2016, it jumped from $14 to $21 in 6 months. They're part of silver's character as an asset, but every time silver moves up, these channels treat it as confirmation of their doomsday thesis, and every time it moves back down, they claim manipulation. Let me show you the manipulation narrative and why it's both partially true and mostly useless. In June 2024, silver pulled back to $28 after the April spike. Within 24 hours, at least 6 of these channels published videos about JP Morgan's manipulation. They showed charts of short positions. They referenced the 2020 settlement where JP Morgan paid nearly $1 billion for spoofing, and they assured their audience that the banks were desperately trying to keep silver under $30. Here's what they didn't tell you. JP Morgan's position in silver had actually flipped. According to CFTC data, by mid-2024, JP Morgan's commercial hedging operations were net long silver for the first time in years. That means they were betting on silver going up, not down. They weren't manipulating the price lower. But here's the deeper issue. Even if manipulation were happening, and I'm not saying it isn't in some form, what good does that knowledge do you as an investor? If JP Morgan can manipulate silver prices, and you know they're manipulating silver prices, how does that help you make money? The answer is, it doesn't. It gives you someone to blame when your investment doesn't perform, but it doesn't give you an edge. Sophisticated investors don't care about manipulation narratives. They care about price action, liquidity, risk-adjusted returns, and portfolio allocation. The manipulation story is intellectually interesting, but financially useless. Now let's talk about the second major mistake these channels made, and this one cost their viewers real money. They misunderstood the difference between demand and shortage. Starting in March 2024, nearly every channel began reporting on physical silver shortages. They showed screenshots of sold-out products on bullion dealer websites. They interviewed dealers who said wait times were extending. They pointed to premiums over spot price increasing from $3 to $7 per ounce. And they concluded that physical silver was disappearing, that the market was breaking, that the $100 prediction was inevitable. But they missed something critical. High demand is not the same thing as supply shortage. Let me explain the difference using real data. In 2024, global silver production, according to the U.S. Geological Survey, reached approximately 27,000 metric tons. That's roughly 867 million ounces. Industrial demand, primarily from solar panels, electronics, and electric vehicles, consumed about 600 million ounces. Investment demand, which includes coins, bars, and ETFs, added another 250 million ounces. That's 850 million ounces of demand against 867 million ounces of supply. The market was essentially balanced. So where was the shortage? The shortage was in retail products at certain price points at certain times. When silver spiked in April, retail investors rushed to buy physical metal. Dealers, who typically keep 2 to 4 weeks of inventory on hand, sold through their stock in days. It took mints 2 to 3 weeks to produce more coins and bars to restock dealers. During those 2 to 3 weeks, products appeared sold out on websites. Premiums spiked because dealers were charging more for immediate delivery versus waiting. But this wasn't a supply shortage. This was a logistics bottleneck in the retail distribution chain. The silver existed, the mines were producing it, the refineries were processing it. It just wasn't in the form of 1-ounce coins sitting in a dealer's warehouse ready for immediate shipment. Here's how you know the difference. If there was a true supply shortage, premiums would have stayed elevated permanently. But by July, premiums had collapsed back to $3 to $4 over spot. Wait times returned to normal. Products came back in stock. What happened? Did the shortage end? No. The retail panic ended. Investors who bought in April at $32 with $7 premiums, meaning they paid $39 total, watched silver drop to $28 by June. They were underwater by $11 per ounce, and the channels that told them to buy immediately, that told them the shortage meant silver was going to $100, those channels moved on to the next crisis narrative without acknowledging what had happened. The third mistake, and this one reveals a lot about how YouTube as a platform shapes financial content, was the timeline compression. Every prediction was imminent. Silver to 100 by March, COMEX collapse by June, physical disappearance by August. Why? Why couldn't silver reach $100 over 5 years? Why couldn't the shift away from paper silver be a decade-long process? The answer is because YouTube's algorithm doesn't reward patient analysis. It rewards urgency. A video titled "Silver Could Reach $100 by 2030" gets 800 views. A video titled "Silver Hits 100." This month, the banks are panicking, gets 40,000 views. I know this because I tested it. Before starting this channel, I analyzed 6 months of performance data from financial content creators. Videos with urgent timeframes averaged 3.2 times more views than videos with long-term analysis. Videos with all caps words in the title averaged 2.7 times more views than videos with neutral titles. Videos predicting collapse averaged 4.1 times more views than videos predicting stability. Do you see the problem? YouTube is literally financially incentivizing creators to be sensationalist and short-term focused. And most creators, even if they start with good intentions, eventually optimize for views because views equal revenue. A channel with 50,000 subscribers making urgent prediction videos can earn anywhere from $1,500 to $4,000 per video depending on CPM rates and watch time. A channel with 50,000 subscribers making measured long-term analysis videos might earn $400 to $900 per video. Over a year, that's the difference between making $25,000 or $70,000. That's the difference between a hobby and a living. So creators are economically pressured to make urgent predictions, even if those predictions are unlikely to come true. Now let's examine what these channels actually got right, because this is important. If we only criticize, we're not learning. If we're not learning, we're just as bad as the people making bad predictions. So what did they correctly identify? First, industrial demand for silver did increase substantially in 2024. Solar panel installation grew by 18% globally year over year. Each megawatt of solar capacity requires approximately 32,000 ounces of silver. That's real demand. Electric vehicle production increased by 12%. Each EV uses approximately 0.5 to 1 ounce of silver depending on the model. That's real demand. Electronics manufacturing, particularly in semiconductors and 5G infrastructure, grew by 9%. The fundamentals were and are bullish for silver. They were correct that the gold to silver ratio was compressing. At the start of 2024, by December, that ratio had compressed to around 75 to 1. Historically, the ratio has averaged closer to 60 to 1 over the past century, and in pre-20th century markets, it was often 15 to 1. So the directional call that silver would outperform gold was correct. They just drastically overestimated the magnitude and speed. Third, they were right about central bank behavior, continuing a multi-year trend of diversifying away from dollar-denominated assets. While central banks don't typically hold silver, this behavior does validate concerns about fiat currency stability and the long-term value proposition of precious metals. The narrative that something is changing in the monetary system isn't crazy. There's evidence supporting it. Silver probably will reach $100 at some point. The fundamental case is strong. Industrial demand is growing structurally, not cyclically. Mine production is relatively inelastic because most silver comes as a byproduct of copper, lead, and zinc mining. You can't just produce more silver. The way you can increase oil production by drilling more wells, these fundamentals matter, but probably doesn't mean certainly. And at some point doesn't mean this month. Let me show you what actual sophisticated analysis looks like. In August 2024, Bank of America released a Commodities report. In that report, they laid out 3 scenarios for silver through 2026. Their base case, which they assigned a 60% probability, had silver reaching $52 to $58 by the end of 2025, driven by sustained industrial demand and modest investment flows. Had silver reaching $85 to $95 if investment demand accelerated significantly, perhaps due to a banking crisis or currency devaluation. Their bear case assigned 25% probability if we entered a severe global recession that destroyed industrial demand faster than investment demand could compensate. Notice what they did there. They didn't say silver to 100, it's happening. They said, here are 3 possible futures, here's how likely we think each one is, and here's what would need to happen for each scenario to play out. That's analysis. That's what professionals do, which is above their base case, but well below the YouTube predictions. More importantly, the path matched their expectations. Now I want to address the China export ban narrative because this was arguably the most misleading story of the entire year. Starting in November 2023, China announced that certain strategic metals would face export restrictions beginning January 1st, 2025. Let me tell you what actually happened and why the reality is more complex and less dramatic than the thumbnail suggested. They also consume approximately 3,800 metric tons domestically in manufacturing. That means China is a net exporter of about 400 metric tons, or roughly 12.9 million ounces annually. That's not nothing, but it's also not market-breaking. Global silver production is 867 million ounces. For context, Peru produces 4,100 metric tons, and Mexico produces 6,000 metric tons. They're both larger producers than China. But here's what the export restrictions actually did. They created a price arbitrage opportunity. In Shanghai, silver was trading at a discount to London and New York prices by as much as 4 to 6% in December because Chinese manufacturers had access to supply that couldn't be easily exported, so domestic supply exceeded domestic demand at world prices. Prices fell locally to equilibrate. Meanwhile, YouTube channels were claiming Shanghai silver was trading at massive premiums, showing charts of $85 or $90 prices. What they were actually showing was retail coin prices in China, not wholesale or futures prices. Those retail premiums existed because Chinese citizens, worried about economic instability and property market collapse, were buying physical silver as savings. But that's not evidence of a supply crisis. That's evidence of capital flight and domestic economic concerns. The Shanghai Futures Exchange, which is the transparent wholesale market where actual price discovery happens, showed silver trading at a discount to COMEX and LBMA through most of December. On December 15th, COMEX silver closed at $71.85. Shanghai silver closed at $70.12. On December 22nd, COMEX closed at $73.90. Shanghai closed at $72.45, a discount of $1.45. Instead of Chinese demand draining global supply and spiking prices, Chinese supply being trapped domestically depressed local prices. Now let's talk about COMEX inventory and why the COMEX is empty narrative is misleading. At the end of December 2024, COMEX registered silver inventory, which is silver available for immediate delivery, stood at approximately 57 million ounces. Eligible inventory, which is silver stored in COMEX vaults, but not available for delivery unless the owner chooses to make it available. Total COMEX silver was therefore 300 million ounces. That's only 57 million ounces, and open interest is over 180 million ounces. The COMEX is going to default. Open interest represents the total number of outstanding contracts, but 98% of futures contracts are closed before delivery. Traders use futures for price exposure, not to take physical delivery. In December 2024, COMEX processed 4.2 million ounces in delivery. Registered inventory was 57 million ounces. That's 13.5 times the monthly delivery requirement. Furthermore, eligible inventory can be converted to registered inventory almost instantly. If delivery demand exceeded registered supply, vault owners would simply redesignate eligible silver as registered and deliver it. The premium they'd earn would make it profitable. Registered inventory dropped from 92 million ounces to 48 million ounces, but then recovered to 63 million ounces within 3 weeks as eligible inventory was converted. The system worked exactly as designed, because it supports the narrative that paper silver is fake and only physical silver is real. That doesn't mean the paper market is on the verge of collapse. In 2011, when silver hit $49, the COMEX handled it. You might be thinking, okay, but what if you're wrong? What if silver does go to 100 in the next 3 months? I could absolutely be wrong. High drama scenarios is a terrible strategy, regardless of whether those scenarios occasionally come true. Let me explain with math. Assume there's a 15% chance that silver reaches $100 in the next 6 months. That means there's an 85% chance that silver does not reach $100 in 6 months. But you're much more likely to either make modest returns or lose money if silver stays flat or falls. The expected value of your investment isn't determined by the best case scenario. It's determined by the probability weighted average of all scenarios. A portfolio that might triple if everything goes right, but will lose 40% if the most likely scenarios play out is not a good portfolio. This is why sophisticated investors diversify, accepting that some positions will underperform so that the portfolio as a whole can generate consistent returns with manageable volatility. A balanced precious metals allocation might be 40% gold for stability, 30% silver for volatility and industrial exposure, 20% mining stocks for leverage to metal prices, and 10% cash or short-term bonds for liquidity and opportunity. Within the silver allocation, you might hold 60% physical. This kind of structure lets you participate in silver's upside without being destroyed if silver disappoints. If silver drops to 50, you lose on silver, but your gold and bonds buffer the damage. If silver stays at 75, you're fine, with $7 premiums, because channels told them silver was going to 100 immediately. When silver pulled back to $28, they were down 35%. They couldn't sell without taking a massive loss. They missed other opportunities because their capital was tied up in an underperforming asset. And the channels that told them to buy, which is the core of why I wanted to make this video. There is no accountability in financial YouTube. Creators make dramatic predictions, collect ad revenue when silver didn't hit $100 in 2024. Instead, they posted silver's 2025 breakout. Why 150 is the new target. The goalpost moved, the narrative evolved. I want to do something different on this channel, and I'm putting it on record right now so you can hold me accountable. Base case, 60% probability. Silver trades in a range between $65 and $85, ending the year around $78. Bull case, 20% probability. Silver breaks above $90 if we see a banking crisis, debt ceiling disaster, or major geopolitical shock. Bear case, 20% probability. Silver falls below $60 if we enter a severe global recession with demand destruction. Now let me show you the business model behind these channels, because understanding the incentive structure explains everything. A channel with 30,000 subscribers uploading 4 videos per week at a CPM, which is cost per 1,000 views, of $6 to $12 for finance content, that's $1,200 to $4,800 per month in ad revenue. But that's just the beginning. Many of these channels have sponsorship deals with bullion dealers. A typical sponsorship might pay $500 to $2,000 per integrated mention depending on channel size. If you include 2 sponsor mentions per video, that's another $1,600 to $8,000 per month. And when viewers click through to a dealer using the channel's affiliate link and buy silver, the channel earns a commission. If a channel drives $100,000 in monthly sales, that's another $1,000 to $3,000. A successful silver channel can generate anywhere from $4,800 to $15,000 per month. Scale that to 100,000 subscribers, and you're looking at $10,000 to $30,000 per month. And the content that generates this income isn't balanced analysis. It's urgent predictions, crisis narratives. I'm not saying every creator is consciously scamming their audience. Many probably believe what they're saying, but the economic incentives of the platform select for sensationalism whether creators intend it or not. Here's a question I want you to think about. If a channel is sponsored by a bullion dealer, what kind of content is that channel incentivized to create? Content that makes you want to buy silver, not content that helps you make optimal investment decisions, not content that explores whether silver is the right investment for your specific situation, not content that compares silver to other assets. This isn't conspiracy. When Bank of America publishes a commodities report, they're not trying to sell you silver. If their analysis is consistently wrong, those clients cancel their subscriptions and Bank of America loses revenue. So Bank of America is economically incentivized to be accurate. YouTube creators face the opposite incentive structure. Accuracy is irrelevant to the business model. In fact, accuracy might hurt the business model if accurate analysis is boring or doesn't support buying silver. Now, I want to address silver's actual investment case, stripped of all the drama, and explain when it makes sense and when it doesn't. Silver is fundamentally an industrial metal with monetary characteristics. About 60% of silver demand is industrial, about 25% is investment, and about 15% is jewelry and silverware. This composition makes silver different from gold, which is about 90% monetary and jewelry demand. In recessions, industrial demand falls and silver typically underperforms. In expansions, especially expansions driven by technology and clean energy, industrial demand rises and silver can outperform. The bull case for silver rests on three pillars. Global solar installation is growing at 15 to 20% annually as costs decline and climate policy drives adoption. If solar continues growing at this pace, silver demand from solar alone could reach 250 million ounces by 2030, up from 130 million today. That's structural demand growth. EVs use more silver than traditional cars for electrical systems, battery management, and charging infrastructure. As EV penetration increases from current 5% of global auto sales toward 20 to 30% by 2030, annually. Third, into a solar panel or electronic component, it's economically unrecoverable for decades. This means supply available for investment is shrinking even as mine production stays relatively flat. The bear case for silver is equally important to understand. They thrifted, reducing the amount of silver per unit. Demand fell by approximately 15% over 3 years. If successful, this could eliminate billions of ounces of future silver demand. If we enter a global recession, industrial demand falls faster than investment demand rises. Third, silver is more volatile than gold, which means it's psychologically harder to hold. Most retail silver investors sell at the worst times because they can't stomach the volatility. Most investors who bought in April sold in June, locking in losses just before silver began rallying again. This behavioral pattern means silver underperforms its theoretical returns for most investors. It makes sense as part of a diversified portfolio for investors who can tolerate volatility, who are buying systematically rather than trying to time the market, and who view it as insurance plus upside rather than a get-rich-quick trade. It makes sense for someone who thinks, I want 5 to 10% of my net worth in hard assets in case the monetary system becomes unstable, and I want that allocation tilted towards silver versus gold, because I think industrial demand growth gives silver better long-term appreciation potential. That's a reasonable thesis. What doesn't make sense is someone putting 70% of their net worth into silver at all-time highs because a YouTube video said COMEX is collapsing. Let me give you a framework for evaluating any financial prediction you see on YouTube or anywhere else. Ask these 5 questions. If someone says silver is going higher, that's not a prediction. A prediction is silver will reach $95 by June 30, 2025. If they're certain, they're either lying or delusional. No one is certain about markets. Supply numbers, demand numbers, inventory levels, price correlations, historical precedents. If silver doesn't reach 95 by June 30, does that mean the analysis was wrong, or will the goalpost move? Fifth, what is the predictor's track record? Have they made similar predictions before? How did those perform? Apply this framework to the channels I analyzed, and you'll immediately see the problem. Most make vague claims like, silver is going much higher soon. They assign 100% certainty. They support claims with narratives about manipulation and conspiracy rather than data. They never define what would prove them wrong, and they never track their historical accuracy. Here's what I'm going to do differently. Every quarter, I'm publishing a performance review. I'll show you what I predicted, what actually happened, and why I was right or wrong. I'll show you my own portfolio allocation, not as advice for what you should do, but as proof I'm willing to put my money where my predictions are. I'll cite sources for every data point. I'll give probability ranges, not certainties. And I'll admit when I don't know something, which is often. This won't get as many views as silver to 200 this month banks are panicking. But it will build trust with viewers who care about making good decisions rather than feeling excited about bad ones. The financial media landscape, including YouTube, is designed to make you feel urgent, scared, and excited. These emotions drive engagement. Engagement drives revenue. But these emotions also drive terrible investment decisions. Urgent investors buy at tops. The only way to win is to opt out of the emotional manipulation. That means diversifying your information sources, questioning everything, demanding evidence, thinking in probabilities, and making decisions based on your specific financial situation rather than generic narratives about market collapse. Silver might go to $100. What I do know is that the way you make money in markets is not by making dramatic bets on low probability scenarios. It's by consistently making asymmetric bets where your potential upside exceeds your potential downside, compounding returns over time, avoiding catastrophic losses, and keeping your emotions in check while everyone around you is panicking or euphoric. That's not exciting, that's not clickable. But it works, and 20 years from now, when you've built real wealth through patient, diversified, evidence-based investing, you won't care about the views you didn't get. You'll care about the returns you did.